we have some very, very important questions to answer in this video today. So we got to figure out first off, is there a real estate crash coming? Is there a real estate bubble? Is there some type of 2008 situation that we need to be worried about right now? And next thing, if there is it going to crash the stock market? I want to talk about Michael Canto, who is the head of research, I believe, with Piper Sandler. So Michael Canto here, he's got a great Twitter account if you want to check him out. So he has this thing called, it's called the HOPE Index, a roadmap for how the economy responds to changes in rates, okay? So we're talking about interest rates, the Federal Reserve, right? And so what happens when the Fed goes and they hike interest rates, essentially? Well, according to the work of Piper Sandler and Michael, you see it first inside the real estate market, and then you see it in new orders, and then you see it finally in profits. Well, not finally, you see it in profits third, and finally, you see it in employment. And that's the thing that we want to see if is this going to happen, right? So if the first thing to kind of start showing signs of a potential recession, a potential big issue in the economy is housing, well, then we want to know if that's going to happen, right? And so let's talk about this. So let's start with the H, basically, and so that's the NAHB, right? And so over here we have NAHB, United States NAHB Housing Market Index. The NAHB, so that's the National Home Builders Association. This is where it kind of starts, right? It starts with asking what's going on with the people involved with the business of building new homes. It's a leading indicator, right? So you look at this and it's supposed to tell you over time what might happen, right? And so if you look here in 2005, this was a leading indicator and it showed that new housing went down dramatically. And we know that the housing problems didn't really end up inside the stock market until 2008, but they were inside the housing market already between 2005 2007 time period. So as we could see, there was a big decline, and as over here we could see there's also starting to be a big decline. So I would say the first thing that we want to know is the NAHB info, and that's showing us that yes, there is a decline currently going on, and it's leading. We have new privately owned housing unit starts, right? So housing starts. This down here, similar situation, right? It was peaking in 2005, 2006, plummets down into the 2009 period, and it slowly goes up, and then we hit another COVID period here where things went down dramatically. But of course, that was kind of like a one-off type situation, and now we're back to having pretty big decline in this one. If we go back, you could see it starts with NAHB, then permits, right? New orders. So if we go ISM Manufacturing Index, we have this part here, and as you can see, again, 2008, what happens? Well, let's say 2005 period, that's when these things start happening. Boom. Suddenly, markets collapsing, real estate's down, economy's going into the hole, and things are not looking too good. Now, you switch it over here to 2022 period, you got a kind of similar thing going on where we have a declining ISM manufacturing. Now, you don't want to just take one of these just for granted. You want to kind of combine them all and kind of look at all the different data points and decide for yourself if all of these kind of point towards some type of recessionary environment. And of course, like we saw, we want to see if real estate is going to have an issue. Okay, so now let's talk about 2008 versus where we are right now in 2022. So this is from Eric Basmahian. So this is he's a great Twitter handle at EPB Research. On the left side here, you have 2005, and on the right side, you have 2021, and this is annual home price growth. And as Eric says here, this is the map of the price growth at the peak of the last housing bubble in 2005. The dark purple spots, which you see Phoenix, you got Florida, you got Los Angeles, you got Nevada. So those are the biggest bubbles. So for the highest price growth, right? And then there's a lot of more yellow going on, which is not that bad. Eric says this is a map, home price growth at the peak of today's housing bubble in 2021. So we're looking at the peak last year before things kind of cooled off a bit where they are now. See the difference? In 2005, home price growth was concentrated in certain states, namely Arizona, Nevada, California, Florida, and today it's everywhere. So you're not seeing that really hyper growth that you saw in those few states, but you're really seeing elevated growth that's more than it should be all over the country. Another thing that he tweeted out is that the month supply of new single-family homes is skyrocketing, right? And why do we care about that? So if supply is going up, that potentially means people aren't buying houses, right? There's going to be supply in the system. It's going to take longer to get those houses sold. And what happens? Well, maybe people are going to decrease their price. You have all these other competitors now in the market. People have all these options maybe to get new homes. And people are starting to compete with pricing their homes by lowering them to try to get people to buy them for lower prices if they're trying to sell their homes, right? Eric says the month supply data shows how many months it will take to clear current pool of inventory at current prices or the current pace of sales, right? And so if it's too high, what do they need to do? Well, maybe they have to lower the sales, right? So the pace of sales stops going up as much, then maybe inventory will start flowing better. Look how close it's getting to the 2007, 2008 time period where that peaked, right? So again, this can be looked at as a potential warning sign about what's going on with supply in the real estate market. Then you have months of supply in U.S. single-family homes. So this is showing existing single-family homes, so the green one, versus new single-family homes. And essentially what the deal is here, what Eric says, is that because single-family homes are really connected to builders and the economy and jobs, right? Because there are people who are building these homes, contractors, subcontractors, laborers, the companies that are managing these people, building these homes. This is an important part of the economy, right? And so this is more important, he's saying, than existing family homes, because these are homes that have already been built, right? So it doesn't really have quite as much as a pulse on the economy as new homes do. Okay, well, Fed is hiking interest rates. They're trying to stop the economy from, they're trying to stop inflation, right? Over here we have going from sub 3% all the way up to 5.5%, right? So that is a huge difference in the increase in a 30-year rate. What's happening right now is not exactly what was happening back then, right? Right now, it's getting a lot more expensive to own a home for the same home than it was a year ago. We can see that here. This is from Jeff Weniger. And so basically, Jeff shows here that this is the inputs. So you have the home price. So if you have a home price of $500,000, right, and you're selling your house, you have $250,000 in equity in your home. This is your mortgage balance, same $250,000, and your mortgage rate's 3%. You're gonna pay $1,054 as your mortgage. That's what you're currently paying for your current home that you own. That's $500,000. Now, you go from a $500,000 house, and let's say you want to upgrade your home. You have a family, your family's growing, you got a new job, you're making a little bit more money, right? And so what do you want to do? Well, you want to increase your living standards. You call it a move-up home buyer, right? That's what Jeff calls it here, a total disappearance of move-up buyers. You got a new job. You're moving across the country to a new location, and you just want to move, right? Okay, you're going to sell your home that you're paying 3% for a mortgage rate. You're paying $1,054 for that home. You're going to roll in your equity. You're going to pay your $250,000 into the new home. But it's going to be $1,427 now for a mortgage. That's like a 30% increase in your mortgage payment for the same exact price of home, right? There's no difference anymore, right? This is what is going on. The move-up home buyer, it's getting a lot harder to move up based on what people were paying for with lower rates. Now, if you go over here, let's say you go even further, go from $500,000. Let's say you make a good raise, right? You want to have a more, more room for your family or something like that. You have a few kids, $500,000 to $800,000. Well, you're going from a $1,054 mortgage to a $3,140 mortgage. That's 3x the price, right? So it's not as easy to be a move-up home buyer right now, and that's one of the things that is probably stalling this market, right? The real estate market, because people can't afford to go ahead and pay 3 times the amount of money for a house that's a little bit bigger. My man Michael Batnick over here, who I love, so he says he's showing distributions of outstanding primary residential mortgages by interest rate. So basically, how many people own mortgages with what interest rates? So 34% of people have interest rates at less than 3% on their mortgages, right? So I was saying before that going from 3% to 5.5%, 6% is a lot. It really hurts. And 34% of people have interest rates with those lower 3% interest rates. 3% to 3.9% rates 39% of the population. So 73% of people who own homes fall into this less than 3.9%. And now, if you're going to go move, you're going to be a move-up home buyer, why would you go from your house that you're paying your, let's say, 3% mortgage or maybe even less, up to like a 5.5%, 6% mortgage? This is kind of the issue that we're dealing with. Why would someone do that? How many people are going to actually want to do that? The Fed's probably not going to lower interest rates anytime soon, so this is what we're dealing with right now. You have these people who are locked into these great mortgage payments, but they have no incentive to go out and say, I'm going to go buy a new house. We see this here with the home purchases are getting canceled at the highest rate since 2020. So basically, 16.1% of monthly pending home sales fell out of contract, right? So basically, people are stopping their home that they were going to buy. Their contracts they're being stopped, right? 16.1%. That's a big number compared to what it was, let's say, just a few months ago at the start of the year, where it was, let's say, under, let's say, in the 12% area, right? So it's starting to rise. And so this is what's going on in the real estate market, right? People are probably not going to want to go out and get new homes if they are locked in great rates. And can real estate be in a bubble? Yes. Will prices fall? I think they will. Are they going to hurt the economy? Is it going to be contagious, right? Is it going to fly into the stock market? Is it going to lead into the economy? Are people going to lose their jobs because of it? This is where I don't necessarily think it's going to be as bad as it was back in 2008. Financial debt plus household debt to GDP, 220%. People were drunk on financing. People were drunk on home equity loans and credit. They were going out, they were buying jet skis, they're buying boats. I had friends that did that back in the day. This shows me that it's not like that now, because now we're at 151%, right? So we don't have the consumer issues, I don't think, right now in personal people's bank accounts, the amount of money that they have, the amount of money that they're leveraged, right? The amount of debt that they're holding. I don't see that right now. To me, this is not going to be an issue that's going to be contagious, that's going to spread all around the economy, right? It might hurt some people in the real estate market, right? And of course, a lot of people have their wealth from their real estate, but I don't think it's going to spread into the stock market, essentially. I don't think it's going to lead to a 2008 type of recession. That's what I'm saying. So to show again this Michael J. Kramer chart that I've showed a few times now, where he basically overlays the stock market of 2007, 2008, 2009 time period with today's stock market. And let me just explain to you what we're looking at here. The yellow line is 2008. The white line is today. We're sitting right here. This bounce that just occurred right now, that we're in right now for the past few days, this literally looks exactly like what happened in 2008 before the bottom fell out. So it's kind of scary. But what I don't see here is, remember what's going on in this time period, in this yellow line. Okay, you have Bear Stearns, you got Lehman Brothers, you have banks failing, you have AIG, banks, financial institutions. What did they do? They created subprime mortgages, mortgage-backed securities, right? They bundled them into securities. They took these bad loans that people started defaulting on because they can't afford their giant mortgages that they shouldn't have had in the first place. So they default, and then suddenly these banks that they're rolled up these mortgages, they start losing all this money because their mortgages are basically valueless. They're selling for pennies on the dollar, right? And so this whole thing unwinds. Suddenly it's contagious. The banks, the financial institutions, even the insurance companies get swept up into this thing, and you have a giant financial disaster. Do I think that's going to happen today? I don't see that. Remember, this chart to me doesn't look like we're too over leveraged, right? Even if it did happen, we don't have nearly as much of the percentage of our GDP inside of those things. So I don't see this particular thing happening. What do I think? I don't think that this is going to go down to this level, basically. I don't think, and you quote me on that if you want to, I don't see a giant collapse coming in the next few months. Could be wrong. I hope I'm right. Could be wrong. So that's all I have for today. Let me know if you liked this video. Subscribe to see future videos like this. Hit that like button if you liked it. And I got another video coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.